Hello, everyone. Welcome to Market Week in Review for the week of October 31st, 2025. My name is Bei-Chen Lin. I'm a senior investment strategist and head of Canadian strategy here at Russell Investments. Today, we'll be discussing three major topics. First, we'll talk about the latest U.S.-China trade developments. Next, we'll recap the central bank actions this week. And finally, we'll wrap up with a look at the U.S. earnings season. So let's get started. First, in terms of U.S.-China trade developments, this week, the big story was the meeting between President Trump and President Xi Jinping. And after the two presidents met, it was announced that both sides had agreed to certain things. And while it's not necessarily a full-fledged final trade deal per se, at least it was an incremental step in the positive direction. We saw the U.S. agree to lower its tariffs on Chinese products by 10%. We saw the Chinese side agree to purchasing a significant quantity of soybeans and other agricultural products from the U.S. We saw both countries agree to delay their imposition of port fees on each other. And finally, we saw China agree to delay the imposition of controls on rare earth minerals in exchange for the U.S. delaying the imposition of some controls on critical exports to China. So broadly speaking, from our perspective, we wouldn't necessarily call this agreement groundbreaking per se. And I think when you look at equity market reactions, equity market futures overnight were relatively measured, and into the trading day on Thursday, October 30th, you actually saw equity markets pull back instead of gaining momentum. Nevertheless, we do think that this development represents a bit of a dialing down of the temperature between two countries, and ultimately we do think it's a step in the positive direction in terms of both countries being able to continue to work towards a more all-encompassing trade agreement perhaps later on down the road. Speaking of tariffs and trade, it's also important to note that next week the Supreme Court will have a hearing on whether or not the administration can continue to uphold those large reciprocal tariffs. Ultimately, though, even if the Supreme Court were to strike down some of those tariffs, the administration does have other avenues of implementing tariffs on key trading partners. The main thing to keep in mind, though, is that based on the current tariffs that are in place, ultimately, at the end of the day, that would represent only a moderate to modest drag onto U.S. economic growth, rather than be something a little bit more significant in nature. So our base case continues to be that the U.S. should be able to achieve a soft landing outcome. Next, I want to talk about the key central bank actions we saw this week. Starting with the Bank of Canada, as expected, they lowered their overnight interest rate by 25 basis points. The benchmark rate in Canada is now 2.25%. This number is significant because the Bank of Canada believes that the neutral rate of interest, which is the rate of interest that neither helps nor hurts economic activity, is somewhere between 2.25% and 3.25%. So interest rates are now at the lower end of that neutral range, and that means in theory that Canada would have a much higher bar for more rate cuts from here on in, and the Bank of Canada said as much in their statement. Nevertheless, we would not rule out the possibility of even more rate cuts by the Bank of Canada in the months to come and into 2026, because ultimately the Bank of Canada will be data dependent. If the Canadian economy were to stabilize at current levels, then we think the Bank of Canada might maintain interest rates steady. But if the Canadian economy were to slow further, and once again, we do think that the Canadian economy is a little bit more at risk of a slowdown compared to the U.S. economy, if we were to see a deeper slowing, then that could necessitate the Bank of Canada cutting rates again in December and perhaps even doing more rate cuts into 2026. From the perspective of the Federal Reserve, they also cut interest rates by 25 basis points at this meeting this week, and that was once again widely in line with consensus expectations. We did have a bit of a dissent, both in terms of one voter who voted for a 50 basis point cut and one voter who preferred to hold rates steady at the Fed instead of cutting rates at all. Ultimately, Chair Powell expressed that the Fed has to continue to be data dependent. While the U.S. government shutdown does mean that they have less data that they have access to, there are other sources of private sector alternative data that the Fed can use to get a grasp on the state of the economy and the state of the economic environment. Ultimately, our assessment continues to be that although the U.S. labor market has cooled somewhat, the U.S. labor market still hasn't broken just yet, and that's why we think that the Federal Reserve can be relatively measured in terms of the rate cutting cycle and bring rates to a more normal level gradually over time. Finally, the Bank of Japan opted to maintain interest rates at the current level. We do expect that over time into 2026, they might need to continue their rate hiking cycle in order to be able to normalize interest rates. Finally, a quick word on earnings. We obviously had earnings reports from several large tech companies this week, but we also had earnings reports out of many companies in the US in general. And broadly speaking, when you look across the landscape of US companies, you're seeing once again another quarter of pretty strong earnings growth. S&P 500 earnings as a whole are tracking above 12% year over year. And when you look at revenue growth is actually tracking at around close to 8% year over year, which is one of the highest paces of revenue growth we've seen in some time now. And so ultimately, that supports this idea that as long as we continue to see good earnings growth from U.S. companies, that should ultimately help to keep layoffs low and ultimately help to preserve the soft landing in the U.S. That's all from us. Thank you for tuning in, and we'll see you next time on Market Week in Review.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.